All right. Well, welcome everybody. This is Brian Coester. I'm the CEO of Coester Valuation Management Services. We're a national appraisal management company located in the Washington, D.C. area. And this is part of our webinar series called Conversations with Chrisman. This is the second one. And on the phone and on the webinar with us, we have Rob Chrisman. Rob, say hi.
Hello.
Thank you. Thank you. Thank you. So what we did is solicited feedback and questions from our customers from the industry, and just kind of wanted to give Rob a chance to answer them for you guys. I know if you don't know anything about Rob, Rob is what we call an industry legend. He began his career
Hardly.
began his career over 28 years ago with First California Mortgage, assisted in secondary marketing until 1998. He is on the board of several mortgage banking companies, and is the owner of Chrisman LLC. If you look at most of the news and articles around the industry, Rob is really the word on the street and a very powerful voice in the mortgage industry. He's on the board of Fairway Independent, People's Bank, Inheritance Funding, First Mortgage, as well as an associate of the Stratmore Group, a member of the California Mortgage Bankers Association, and gets up every day at 4 a.m. in the morning to write this great commentary. Anything you'd like to add to Rob about yourself?
No, that pretty much sums up my entire existence. Thank you.
Okay, well, good. So the goal here is to have a conversation with Chrisman, right? So if you have any questions, we received a ton of questions and a ton of great feedback, and the objective is really just to have that conversation, answer some of your questions. I know that a lot of the feedback we received are stuff about QM and non-QM, stuff about the end of the year, what's going to happen, stuff about Fannie and Freddie. And so what we're going to try to do is attempt to really answer all those questions. And let's just go ahead and get started. You ready, Rob?
I'm ready.
All right.
Take it away.
So first question, what do you think about QM and non-QM for mortgage bankers?
Well, that is certainly one of the big questions out there, and you let off with it. So if you look back when QM was going to be rolled out in January, there was a lot of fear and trepidation in the industry that nobody quite knew what was going to happen, and if their companies were going to cease to exist and so forth, and if lending was going to come to a screeching halt, which of course it is not. Lending has continued on. But it continues to be a question about QM versus non-QM. In fact, the NBA Stratmore peer group meetings that we had a couple months ago, that was one of the questions, one of the key questions that would come up among the CEOs and the CFOs about non-QM lending and investors and what they were doing, and if they were going to be around for any kind of period of time. And if you think about it, it's not an unusual situation. We went through the same situation about 10 years ago. As volumes have come down and margins have gotten squeezed, it's natural for lenders to look to alternative products, because after all, any company is selling product, price, and service. It's hard to hit consistently all three all the time. And so if everybody's kind of looking at the same price and everybody's looking at the same service levels, then what are they going to use to differentiate themselves in terms of products? And one of the products that's out there is non-QM. And if you look at the number of non-QM investors, especially on the wholesale side, it has really grown by leaps and bounds. I put together a little list here, or I'm looking at a list actually, of wholesalers that are out there buying non-QM loans. And they include United Wholesale Mortgage, which is a big, well-known company, Angel Oak Funding, Athos Capital, B of I Federal Bank, Citadel Servicing Corporation, Decker Global. You've also got First Key and Fremont Bank and Impact Wholesale. JMac is offering non-QM New Leaf Wholesale, Oak Tree Funding, Parkside Funding, Security National, Union Bank. It's quite a few, Western Bancorp. So quite a few lenders, quite a few investors are out there offering non-QM loans. And so I think some of the fear and trepidation that the industry had regarding non-QM product has gone away. Now, that does not mean that lenders can just willy-nilly offer non-QM loans. They have to be sure that they're meeting the ability to repay requirements and so forth that are out there. But nonetheless, non-QM lending is not quite the bad thing or the evil thing that lenders thought it was. And in fact, the CFPB, when they set up QM for the industry, came out and said that a non-QM loan is not necessarily a bad loan. It's not a bad loan at all. It just doesn't fit into the guidelines that define a QM loan. So, Brian, you hear all the time, I hear all the time from originators that have borrowers with, you know, a 50% loan to value and, you know, millions of dollars at the bank, yet the DTI is, you know, above a QM prescribed limit, and therefore they're having trouble placing the loan. And that's very unfortunate. I think that a lot of borrowers have been left out because of certain criteria, and this being one of them. But in terms of the question about non-QM versus QM, non-QM investors are certainly out there. They seem to be growing every month, and it's nothing to be feared. So just if the loans are done correctly and the borrowers demonstrate an ability to repay, and you handle the reps and warrants to your company's needs, then a lot of lenders are moving towards offering this product.
Now, is there any advantage, and this is just a question, is there any advantage from a production standpoint if you're an LO working with a bank versus, just say, a mortgage bank?
Well, yeah, I answered the question mainly in terms of lenders. If you look at the businesses surrounding lending, for example, warehouse lenders, you know, will they lend on non-QM loans? That's a big question that warehouse lenders are working on. If you look at who owns the lender, who owns the company, what is the funding source? Are they comfortable given the perceived risks of non-QM lending? So what do they want out of the deal? And so if you think about the other things, there are other factors. If you're a loan officer, though, looking at a bank versus a mortgage bank, there are banks that offer non-QM products. I don't think you'll find anybody who claims that, for example, interest-only loans were the loans that you know caused the financial crisis. And so you have banks out there with large deposits looking to place money, looking to lend money. They have no problem making interest-only loans. In fact, some of the bigger banks do. Wells Fargo has hundreds of underwriters, mostly dealing with portfolio retention, underwriting non-QM loans. So on the investor side, though, the banks are not generally offering non-QM loans on their rate sheets to, say, correspondents, although I've heard that Chase is buying non-QM loans on a very limited basis. So if you're an originator and you're thinking about, gee, do I really want to originate non-QM loans, and that's going to be my specialty, then yeah, you probably at this point in time your better bet is with a depository bank that has the ability to offer portfolio products. As you know, independent mortgage banks really don't have portfolios,
Yeah.
And so they can make loans that end up in a depository's portfolio, but for the most part, since they're borrowing money from a warehouse bank and lending it out, they don't have a portfolio. So, yeah, banks at this point in time have the advantage in terms of non-QM product if you're an originator and you want to offer that product.
Got it. Okay. So I think that's a. Where do you think rates are going?
Well, let me ask you that. Where do you think rates are going?
So, well, That's the $64,000 question. So I mean, my personal and Phil Hall's a really good friend of mine. Asked me about this, and my personal opinion is that rates will remain stable until the private secondary market comes back. It has to. There's too many questions. There's too many problems that if they fluctuate, within a reasonable differentiation, if they're too high or too low within that, it will cause some market disruption as far as private capital. They might get off the fence as far as home buyers, potential homeowners, and so my opinion is that they will remain stable until private capital starts coming back. What do you think?
All right. Well, hang on. Let me get out my coin here, and I'll flip it to tell you where rates are going to go. Well, that's kind of what it comes down to. On the trading desk, we used to keep a coin, and whenever a client would ask what are rates going to do tomorrow, you flip the coin, or a loan officer would call up or whatever. But it's important for your listeners to think about why rates are where they are. Last May, when Ben Bernanke announced that the Fed was even thinking about curtailing quantitative easing, rates moved higher and basically peaked around the holidays in late 2013, to the point where a lot of lenders divided 2013 results into two pieces, the first half and then the second half, because the second half of the year was a much more difficult environment because rates were rising, production was falling, and so forth. So anyway, it's very difficult, if not impossible, to predict the future consistently and accurately. And anybody who claims they can, you have to wonder why they aren't sitting on a beach somewhere, living the good life, and why are they telling me what their opinion of rates or the stock market is going to be in the future? Why should I listen to this person? Obviously, everybody's going to be right sometime. I don't think anybody's going to be right all the time. So when you think about rates, it's important, like I said, to think about why they are where they are now. And a lot of the smarter guys in the room were saying that rates were going to go up in 2014. Well, we're almost halfway done with 2014, and rates have actually come down. So what these smart guys didn't see was the unrest in Russia. They didn't see the emerging European markets causing a flight to quality here in the States. They didn't see the questions about the Chinese economy. They didn't foresee that our economy was going to be bumping along. Our economy is not doing as well as many thought when you look at some measures like gross domestic product. So they didn't foresee all this happening, and you could lay out a great argument for rates going up, for rates going down, for rates staying the same, and that's fine until Russia decides to do something in the Ukraine, and suddenly we get a flight to quality, and it causes a rally in our market and rates drop. And so when you ask where rates are going, I'm in your camp. I kind of think we'll muddle along here. We could easily be having this call in around Thanksgiving and having rates where they are right now. I think the tendency is for rates to go up a little bit. I don't see them going up a lot. I don't think our economy is doing well enough. I don't think our job growth is high enough to demand higher rates. I don't think the banks, certainly the banks have seen a demand for lending and demand for capital increase a little bit, but I don't see any great reason for rates to be much higher than where they are now. Conversely, I don't think the economy is doing poorly enough to really warrant rates going down much from where they are now. And I'll kind of finish off with it's important, and I mentioned this in my commentary, it's important for originators and the entire industry to remember that the bond market might go up, the bond market might go down, but the price that borrowers see on the rate sheet isn't just purely determined by the bond market, determined by where the 10-year yield is. The price that borrowers see to refinance or to buy a home, a lot of that is based on price adjustments, loan level price adjustments that the agencies have put in place, or the cost of mortgage insurance, or the guarantee fees that Fannie Mae and Freddie Mac have, and those can be, quite large. So if you think about where securities are trading, they go up a little bit, down a little bit, but oftentimes a change in the price adjustments by the agencies or a change in the guarantee fee will have a much greater impact than any move in the bond market can have. And so one of the questions now is, gee, rates have come down since the first of the year. Why aren't more people buying houses? Well, you have to remember these loan level price adjustments have gone up, and the guarantee fees have gone up. And so just last week, the FHFA announced that they were seeking public input in terms of the guarantee fees. And so you think, well, let's just all vote to make them lower and help more borrowers get into houses, and certainly the National Association of Realtors would like to see that, as would other groups. But there's a reason why guarantee fees are where they are. Fannie Mae and Freddie Mac had a tough time. They're making a lot of money now. Some of that money is due to legal settlements, and so it's not expected to continue forever. And so they have to make a profit as well. So the question is, how much profit should they make, and at what expense to the borrowers? So getting back to the original question, where are rates going to go? They'll probably, I think they'll try to nudge higher, but not dramatically so. But it's important to keep those loan level price adjustments down, and that's a big factor.
Got it. I think that answers the question. So this is kind of a little bit, a lot of these questions overlap, but there's a little, what has to happen to get private capital back into the market? So, I mean, obviously there's rates, obviously there's QM, non-QM, which non-QM, would essentially be some private capital, but what really has to happen so we get a healthy mortgage market? What has to happen first?
Well, that's a good question. People have been wondering that for a couple of years now. As you know, jumbo lending ground to a halt around 2009, 2010. It's bounced back here in last couple of years. But it comes down to a question about risk versus reward. What kind of reward does private capital want in order to invest in a residential lender? Or if you're talking about mortgage-backed securities, what kind of yield do they want when they buy a mortgage-backed security? Or if you're talking about servicing, what kind of yield do they want if they buy a pool of servicing? And what is private capital's alternatives? So the private capital, the folks who control hundreds of millions or billions of dollars have obviously a myriad of investment opportunities out there. And so they're looking at corporate debt, they're looking at municipal debt, they're looking at treasury debt, they're looking at foreign debt, they could be looking at equity in companies. I mean, they're looking at just this whole range of things, and obviously some funds specialize in mortgage banking and lending and servicing and so forth. So I think, though, when you talk about private capital coming back in, once again, it comes down to what kind of return do they want on their money. If for example, right now, if you're a Wells Fargo or a Citi or a Chase or a U.S. bank, you're a depository bank, and you've got assets that you're basically paying zero on. And, you have a couple doctors that come to you and a couple orthopedic surgeons, and each one's making, $400,000 a year or whatever orthopedic surgeons make. And they want some 80% loan-to-value loan, and they want a 3-1 arm or a 5-1 arm or whatever it might be. That's a great loan for a big bank to make, or even a small or regional bank to make. It's a great loan. It's a great credit risk, and there are cross-selling opportunities that you have. And so there's no reason for a bank to turn around and try to sell that loan in the secondary market to a non-agency mortgage-backed security investor. There's no reason to go through it because you want that asset on your book. A particular bank might not have any commercial lending opportunity presently that they're looking at, and so they say, "Well, this is a great credit risk. It matches our liabilities. Matches our deposit base. So let's put this on our book." So that loan sits in the portfolio of the bank. So there's no opportunity in many cases for private capital to buy that loan or to buy a security made up of loans like that. Banks are sitting on them. And so if you think about private capital coming back into the market, you have to wonder under what conditions are they going to come back in, or even can they come back in? Or if they can't buy the loans, do they want to buy the servicing? Well, maybe that bank can't hold on to its servicing, so it sells off the servicing through a servicing broker. Okay, well that's fine. So let's play in that space. What kind of returns can we get by leveraging our money and buying servicing? So that's kind of the play that's been going on. That private capital is going, say, more into servicing or even into buying companies. A lot of lenders are out there for sale, or could be for sale at the right price. So private capital is looking at either buying servicing or buying lenders rather than buying pools of mortgages, because the Redwood Trusts and the Barclays and the Nomura's and so forth, Penny Macs, I mean, they've been real slow in terms of issuing new non-agency mortgage-backed securities for the reason I alluded to earlier. Banks are sitting on it. They don't feel the need to sell it, so they're going to sit on it. So private capital has not been buying those securities. Now, if rates were to go up and present a more attractive yield, and the bank might think, well, I could sell this at a profit, or I don't need to hold on to it, whatever it might be, then private capital would come back into the non-agency mortgage-backed security market. But for right now, there seems to be a need or a desire by banks to sit on the products rather than sell them. Of course, that doesn't necessarily help independent mortgage banks who don't have the portfolios and can't really sit on this stuff, and so they are selling loans to the big banks through their jumbo conduits, or to the Penny Macs and the Stearns and the Nation Stars and so forth, Stonegates, who offer jumbo products to correspondents. But the banks are pretty happy originating this stuff through their branches. They buy some through correspondent or wholesale channels, and we haven't seen private capital get back in like many had thought we'd hope, or many had thought we'd seen this year.
So the balancing act to me seems to be keeping the rates low enough to have some production, to keep the doors open, to keep enticing new homeowners to buy, but at the same time figuring out a way, whether it be through the non-QM or the ticking up of rates slowly to attract capital, private capital back into the market, and then kind of all together doing that without disrupting the market enough to cause another major issue.
Right.
I mean, that's
you have to be. Oh, sorry. Go ahead, Brian.
Like a very, very careful balancing act.
Yes. Yeah, you have to be careful what you wish for. If all of a sudden you could snap your fingers and suddenly private money was rushing back into the mortgage market, you have to wonder what happened to the agencies. Did the agencies raise their G fees to such a degree that non-agency loans came in? I mean, as it stands now, banks have lower jumbo rates in many areas of the nation than they do conforming conventional rates, and that's because those loan level price adjustments and the G fees. The jumbo loans don't have G fees. They don't need Fannie Mae and Freddie Mac's guarantee fees on there. They don't have a lot of the loan level price adjustments that the agency products have, and so jumbo rates in many parts of the nation, like I said, are actually lower than conforming conventional. So if you were to say, well, snap your fingers and private money rushes back in, is that because the agencies raised their G fees to the point where it made no sense to sell a loan to Fannie Mae and Freddie Mac? Does Fannie Mae and Freddie Mac really want to do that? Maybe not. Do we want them to? Yeah, maybe not. There's a lot of advantages keeping the GSEs around, and so it is a balancing act in terms of rates, and you have to be careful what you wish for, because rates might go up if all we had was private capital, quote unquote, in the market, and every loan was a non-agency loan. What would that world look like? So
Yeah,
It's important to keep that in mind.
yeah, I totally see what you're saying too. So it's kind of good and bad the position we're in right now.
Right.
So let's go on. So there's is it better to buy or build a mortgage company in this environment?
Uh, well, that's another $64,000 question,
Yeah.
right? I will say that buying a mortgage company is all the rage out there right now, and it has been for last year or so. I continue to receive emails from lenders looking to sell, and I continue to see investors trying to buy mortgage companies. There's been last year we started off the year and there was a big bid-ask spread. You know, anybody thinking about selling their mortgage company wanted a high premium, especially if it was based on purchase business. You know, that's a key metric out there. And so they wanted a big premium. They wanted a, you know, X number of 5 times last year's earnings. Some really arguably outlandish terms. Now that has come in quite a bit as the months have gone on. That difference between the bid and the ask spread between companies selling and companies buying has narrowed a little bit to the point where a lot of deals are getting done. But the premiums have left the market to some degree. But you have a lot of originators out there who want to return to what they do best. A lot of mortgage bankers out there, let's say they started off as just a loan officer and they got very good, and they started a little mortgage brokerage outfit, and that grew, and then they got a warehouse line, and they started dealing with investors. They became mortgage banks. And so, but deep inside, these guys, a lot of management out there, they're just originators who like originating loans. That's their sweet spot. And so you have companies out there where the senior management is made up of originators who don't care so much about compliance. They don't care about HR. They don't care about secondary marketing. They don't care about some of the risks that are out there, the potential buybacks. It's just a lot. It's a minefield, and so they just want to originate loans. And so, financially speaking, they've done very well for themselves, but they're growing weary of the rules and regulations, and so they are looking for a partner to come in, and that partner has HR, and they've got secondary marketing, and they've got accounting, and they've got a compliance department and so forth, which will allow that owner to go back and just originate loans.
So let me ask you this: what do you think kind of piggyback on that? What do you think the proper capital requirements will be to manage, kind of a successful independent mortgage banker? So it seems like the kind of $5 to $10 million won't be enough anymore. What do you think?
Well, nobody I've seen has been lowering their capital requirements. The CFPB is very, very concerned about counterparty risk and making sure that your counterparties are adequately capitalized. Excuse me. Now, that doesn't necessarily happen all the time. Smaller lenders really don't have the staff to run around and audit all their counterparties and look at their financials and so forth and so on. And so you have an environment out there where capital is key. No one's lowering their net worth requirements. The last time, if you have $5 or $10 million, which, heck, that's a lot of money. Let's keep things in perspective. That is a lot of money, especially if you look at the average person in the U.S. making, $40,000 or $50,000 a year or whatever they make. It takes a long time to take, a lifetime, more than a lifetime to save up that kind of money. But companies can do it, and a lot of mortgage companies are worth $5 or $10 million at least. And so the question is, where now? Is $5 or $10 million enough, or is the new norm going to be 20? And I've heard a lot of people I respect in the industry say, yeah, the new norm is going to be something more like 20 million. They'll certainly get you all the agency approvals that you need, certainly allow you to do business with any counterparty that you want, certainly allow you to have a fund to weather any buyback situations, and if you want to grow servicing, you can do that with 20 million. but it gets used up in a hurry if you're not careful. But yeah, I've heard that 5 or 10 might be very thinly capitalized at this point, and that 20 is probably a better level. And above that, of course, is better yet. But yeah, if you're sitting there, I've seen many cases where companies were worth, let's say, $10 million a year ago, and then as 2013 wore on and they started suffering losses, now they have a company worth $5 million, and now they're trying to dig back up, and they're, I should say, trying to increase their net worth back to the $10 million is tough, and so they're selling servicing and so forth and continuing to cut costs. But yeah, if you're if it's keeping you awake at $5 million or $10 million, then it's probably warrants taking a look at. And you're right, Brian. I've heard something closer to $20 million is probably closer to where companies want to be in terms of net worth these days.
Gotcha. Oh, well, that's good. So
so getting back to your original question about whether it's better to buy or build a mortgage company, I see very few companies starting from scratch right now. Very few. In fact, I'm sure they're out there, but I can't think of any offhand. It's the buyers are out there, the venture capital funds are out there, the people with money are out there, the bigger mortgage banks are out there with capital, and so they're finding it easier to buy rather than build something from scratch.
got it. That makes sense. So how do you think the rest of the year will play out?
In terms of
just your general overview. I want your miracle. If you were a fortune teller, how would the rest of the year play out for your typical mortgage banker, which is on this call for the most part?
Yeah. So what I'm seeing out there. I do have the good fortune to visit with a lot of companies and visit with a lot of groups and do some speaking and a chance to meet with folks. What I'm seeing out there are a lot of people who are doing their jobs. I know that doesn't sound revolutionary or anything earth-shattering. I wish I had some kind of catchy thing to say, but frankly, the companies out there who are being successful, the employees out there, the originators out there who are being successful, they've gone back to doing their jobs the way that they may have done them in the past. They come into work, they follow up, they're conscientious, originators are returning phone calls, sending thank you notes, they're doing things that a loan officer should have done all along. Same with senior management. They're doing things that senior management should have done all along. They're not taking a lot of chances out there. They're doing things. They're trying to do things the right way. They're trying to be cost efficient. And so what I'm seeing out there and what I see for the rest of the year are successful companies and successful originators doing exactly that. They're doing their jobs. And it's not always glamorous. They're not going to make $1 zillion a year. But they're going to be around by the end of the year. On the other hand, I do see companies, and it's not necessarily a bad thing. Like I said earlier, you might have senior management who are primarily interested in originating loans, and they may be looking for a buyer. And so I think by the end of the year, we'll see a lot of those companies become part of larger mortgage banks. And on top of that, talk about costs and efficiencies, you'll continue to see the larger lenders out there and investors take a look at their individual business channels and say, okay, do we really want to keep correspondent, or do we really want to keep retail, or do we really want to keep wholesale? So they'll look at these channels of origination, whether or not they make sense, whether or not it fits into their overall business strategy, whether it fits into their geographic footprint, et cetera, into their risk profile, what it costs them to do the business, and take a hard look at those channels and say, we really don't need whatever channel it is. Let's find a buyer for it. Nation Star selling wholesale to Stonegate is the last, I guess, big example of that happening.
And what do you think of the correspondent? Do you think the correspondent will expand or contract in 2014-15?
Well, correspondent lending has always been a very cost-effective way to obtain servicing, to obtain that servicing asset. And so the correspondent channels, back when B of A was doing it countrywide, Wells, Citi, and Chase, it was a great way to add to their servicing portfolios because one person, the correspondent rep, could do, $1 billion a month in buying closed loans, whereas a good wholesale rep might be, $100 million would be a really good month for a wholesale rep, and just like a loan officer, a really good month might be $10 million. So you have one person that you're paying basically to control these relationships and bring in servicing. So the question is, do the big banks, do the correspondents still want servicing like they used to, or is it all going to the non-banks out there, the Walter and the Nation Star and the Stearns and the Pingoras and Two Harbors and so forth and so on? Do the big banks want the servicing? And from what I've seen, the big banks and the non-banks continue to be focused on correspondent channels for different reasons. Like I said, it's a very cost-effective way to obtain business. If you're a non-bank and you want to add servicing, the correspondent channel is a great way to add servicing in a hurry. It takes a lot less time. And so you've seen this influx of companies into the correspondent channel for that very reason. So I continue to see correspondent channel being very viable for a lot of lenders out there, and so I don't see that going away at all.
Gotcha. And there's a kind of a question coming in that I could probably handle, one of very few that I'm able to do. But it was, in your opinion, will new housing starts be enough to make up for the shortfalls we were seeing nationwide in 2014 and 15? Will the shortfall of existing inventory continue to fuel the appreciation we are seeing in certain areas of the country, especially to close to where you live in the Bay Area, where appreciation is very strong? And so the answer to that is that for the last 4 or 5 years, they're about 1.5 to $6 million units short on the number of units they were supposed to build. So they're supposed to build to keep up with just general population growth, around 600,000 units a year. Over the last 4 or 5 years, during the kind of mortgage meltdown, they were only building around 100,000, 200,000. That backlog is about 1.6. So even though now you see a lot of builders, building, filing to being built, you see a lot of new construction. I know in the D.C. area or even the Bay Area, and a lot of the builders that we deal with directly, they're very busy. But it's going to take a couple years before you're going to see that issue being solved with any significant impact, which is kind of a good thing to a certain extent, as you're dealing in areas that took big hits. You're going to see a lot of the foreclosed areas, the areas that were what we call like support cities from the appraisal side, where they're not in the main city. Let's say San Francisco is the main area, but they're kind of outside on the outskirts. That really got hit by this whole foreclosure crisis. You're going to see those get refilled quicker, and kind of the whole cycle repeats itself. So the housing building, the builders are they're definitely addressing it, and they're filing applications. You can see a lot of new developments being built, but it's going to be a couple of years before you start seeing the full benefit or the full realization of all those new construction and stuff, just because it takes a very long time to do so. Rob, you have anything you want to add to that?
No, that was a thorough answer. The one of the big questions that I get is, for a couple of years there, everyone was concerned about the shadow inventory hitting the market and swamping values, and of course loans have been modified, loans have been refinanced, investors have snapped up a lot of these properties. So this big shadow inventory never really materialized, and now the opposite has happened. There's a shortage in many areas. In some of the metro areas, you might have 10 or 20 offers on a property as soon as it hits the market, if it's priced correctly, and so you get into a bidding war, and there's a lot of cash buyers out there, et cetera, et cetera. And so, as you alluded to, there's a yin, there's a yang. The market eventually comes to more of an equilibrium point, and I'm already seeing more for sale signs than I have in quite a while. So at some point, if you own a home and you're thinking about selling and the price has gone up, certainly to the point where where it's worth more than you owe, you're probably taking a good look at selling it. There are still houses and still areas that are underwater, of course, so you don't have that luxury. But then I've heard realtors say, I have clients who are thinking about selling because their house has gone up in value, but I'll be darned, they don't know where they're going to move. They have to live somewhere. So when you talk about people selling their homes, it's important to remember what's on the other side. Where are these people? Where are they going to live? And so the market though is coming back. Like I said, I've seen more for sale signs. The builders will kick in. Once again, it's a risk and return, and if we build it, we're going to be able to make money. Do we have the land? Do we have the lumber? Do we have the resources to build a house? And what are the profits? In many areas, it's still cheaper to buy an existing house than it is for a builder to build a house. And so you've got that dynamic going on out there. But overall, I think we will come back. I think it takes a while for builders to obviously get permits and so forth, and to staff up and get everything lined up to actually build homes. That is happening in some areas. In other areas, it is location. In other areas, foreclosure sales are still a factor. You've seen a lot of markets where prices have really rebounded, especially the ones that really took it on the chin from 2006 to 2012. Those have come roaring back, Nevada, Arizona, Florida, even California. They've done quite nicely, but it's caught a lot of the builders off guard. So eventually they'll catch up, but it does take time, like you said.
And what do you think? What do you think about this whole? There was a recent, Stevens recently came out, and the CFPB recently came out about the whole student debt affecting housing. How do you think that's going to pan out? What do the whole idea of a potential new, the kind of the next generation of homeowners are going to be tied with $50,000, $60,000, $70,000 in student debt.
Well, I keep writing about that in my commentary. I think it's a big deal. I think the government is starting to do something about it. I think Barack Obama did something yesterday about it in terms of student debt. There's more student debt now than there is credit card debt. So go figure. Student debt, of course, can't be discharged in a bankruptcy. The student debt that's out there is, primarily owned by the government, and so the government is very much involved. And on top of that, if you look at who has the student debt, a lot of the student debt is owed by the millennials, who the housing industry is hoping is going to be the next wave of first-time home buyers. And so if they have all the student debt, they might not be able to afford, a house, in which case the housing market stalls out. So it is a huge problem. I don't see it going away anytime in the near future. There can be some things done to help alleviate the situation, but I've talked to a lot of underwriters who say, well, if it wasn't for this $250 a month student debt payment, yeah, they could afford to buy this house. As it is, it's going to take them another year or two to save up, more of a down payment. So it has an impact. I don't know quite what the answer is yet, but it's an issue, and it'll continue to be an issue from an underwriting perspective.
So this is something definitely that the industry is going to have to deal with, and the idea that it's not just going to go away with, new homes being built. It just kind of goes away, as far as the shortage of, homes to buy, things like that. This is something a little more complicated.
Yeah, exactly.
Got it. Yeah, that makes a lot of sense. And then, what do you think about the recent CFPB enforcement? They're starting to come down. I know there was a something where they've charged a title company $500,000 for the way that the title was ordered. There was also, I heard about a $500 million lawsuit or something like that, that they were going to file. What do you think about the CFPB's enforcement year to date, and how is it going to pan out for the rest of the year?
Well, I hesitate because I'm torn. The CFPB is not going away. The CFPB is basically here to stay for the foreseeable future. It's something that everybody in the industry has to deal with. Whether or not they're going to be examined by the CFPB or not doesn't really matter, although everybody should act like they're going to be. I've heard a lot of scathing attacks on the CFPB, their tactics, their enforcement actions, their attorneys being on site, the fact that they handle things their own way rather than going through the courts, the fact that they make a public display out of penalizing lenders or realtors or credit card companies, whoever it might be. On the other hand, to some degree, the industry has brought a lot of this on itself, unfortunately, and whether it's payday lenders or pawn shops or student lenders, whatever it might be, in our case, residential lenders, some of the excesses that were going on 5 years ago or 10 years ago, we're paying the price for those now, and a big piece of that is in the form of the CFPB and its enforcement actions. That being said, the CFPB is doing things. It continues on. We can only expect to hear about more enforcement actions, more financial penalties. The CFPB is examining mortgage lenders for the second time around, which is interesting. A lot of lenders haven't been examined at all, whereas other lenders are being examined again, or will be examined again. I've been notified they're going to be examined again. So the CFPB is out there. You can expect them to continue to monitor lenders. Certainly the exam staffs have become smarter. They aren't quite as naive as they were a year or two ago. A lot of them have a fair amount of exam experience under their belts, and so they're not asking what the difference is between wholesale and retail or wholesale and correspondent. They're often asking tougher, more technical questions, and they really do take their mission to heart. They generally do believe that they are protecting the consumer against, poor residential lending policies and procedures and controls. So they're here to stay. They're not really accountable to anybody, which makes them a danger. Frankly, it's a little bit surprising why Congress gave them that power, basically not being accountable to anybody, and their funding coming from the Federal Reserve rather than from Congress. That may change in upcoming years, but for right now, they're out there. They're adding staff. They're up to about 1,400 people. They want to make their presence known. They want to do what they think is right in terms of the consumer, and it's going to be tough to get in their way.
And if you were a mortgage banker, practical stuff. If you were a mortgage banker and you wanted to be in the good graces, or at least appear to be in the best graces of the CFPB, what's your opinion on these marketing agreements, affiliated business arrangements those types of things? Because it seems to me a lot of those, a lot of the ones that have been under investigation, at least from and I'm a little biased on this, so just to let you know, guys, have been because of those little more complex arrangements where there's some questionable stuff. Do you think there's any realisticness to that, or is that just me looking into it too much?
Well, you should probably be the one to answer that. I do receive emails, usually from companies or individuals who do not have marketing agreements or who are not preferred lenders of a realtor or of a builder. The criteria, the basic criteria that I remind people of is the consumer, does the consumer have free choice, or are they being steered in some way that is, has a negative impact on them and their choice and their borrowing? And if that's the case, then that's a problem. Or does the lender have an undue advantage over its competitors by some use of something that's not, that's not transparent? So that being said, how would you answer that?
So I would answer that by, I've asked I've met with some of the people in the CFPB about this, and basically what their position is, and this comes from title, mortgage, appraisal, settlement services, home builder, every aspect, is that they've asked for hard data that it's in the best interest of the consumer for these arrangements to be made, meaning that it's a cheaper, better process loan. It's in the best interest of the consumer who's getting a loan for a mortgage company or title company or an appraisal company to have some type of affiliation with cheaper, better execution, those type of things. And no one's been able to produce data that says that that's correct yet. And so they've met with everybody from the the settlement groups, some of the advocacy groups, and the positioning is great. This is good because of the borrower has a local referral that we trusted, or that it's better because we're able to market the property better, or something like that, or because we know these people and we're able to have some management oversight, or more I would say oversight, but a little more in tune with the management. But there's no one who's been able to say, okay, here's data that shows it's cheaper, here's data that shows it's better, here's data that shows it's faster. And so because of that, they're sticking to their general, and I would say get the hunch, where they just don't necessarily like it. Even though it's legal, they just don't necessarily like the idea of a builder owning a mortgage company, or a title company being affiliated with a lender, or an appraisal company being affiliated with a lender. And there's a lot of rules around that say you could do it, but you got to follow all this other stuff. There's a whole host of things. And the reason is simply because they don't think it's in the best interest of the consumer. And there's been no one who's, from the best of my knowledge, that's been able to produce hard data that says it is, when they're able to produce hard data that says it's not, or other rules are in the best interest or not in the best interest, and things like that. So I think it's more data driven, and there's legitimacy to that. That's my opinion.
Yeah. Well, data is key. You can't change what you can't measure, right? And so I'm not an attorney. The folks who have put these agreements in place, and then the builders who have realtors, or the realtors who have lenders, or the lenders who have builders, whatever arrangement might be, I'm sure those have been run through countless hours of attorneys looking at them and fine-tuning the agreements and making sure they're copacetic. So I'm kind of looking at it from the outside in. I just once again come back to, is the CFPB is the Consumer Finance Protection Bureau, and is the consumer being negatively impacted by some arrangement? And if so, I would expect that arrangement will be relatively short-lived. So
yeah.
Yeah.
All right. So that kind of, for the most part, wraps up our questions. I just kind of wanted to give you guys, and this is my end of the end of the webinar, information about the company, Coester VMS, my company. We do a lot of these webinars and try to offer value to the industry and you guys. And if you look at our YouTube channel, it's got a couple hundred views with over 100,000, 150,000, couple hundred videos with over 150,000 views, which is by far the biggest YouTube channel in the entire industry. But just a little bit about us. We're a nationwide appraisal management company, flat fee schedule nationwide so that we don't do any fee increases. There's an increased disclosure accuracy. We have regional turnaround time tiers. We can give you everything. We're probably the best combination of appraisal technology, mortgage-backed operation experience, and appraisal. I'm actually a certified appraiser. Appraisal in the industry when it comes to that combination. Our senior vice president is a DE underwriter and ran several large mortgage companies before coming to work with us. And so you get a free AVM credit with every full appraisal order. We do appraiser panels, and then also we probably have one of the better QC systems in the country that we developed internally. It's an appraiser intelligence review that comes along with every appraisal. Experienced staff online, experienced staff and appraisal staff here to answer all your questions, handle all the vendor relations, all the exclusionary list monitoring. We do direct deposit to all the vendors. Can get as specific as you want when it comes to vendor training, or if you want to have validated vendor training so that you ensure, FHA or 2 or 3K appraisers go through specific training. We have a lot of success with builders doing new construction with that to make sure that all their vendors meet specific requirements and go through specific trainings. And then integrations with all the major, LOS systems, as well as can do custom ones. We have our own full tech team that that can handle any custom integrations, reporting, and things like that. So, we appreciate you guys attending this webinar. I know Rob, we appreciate all your insight, and we have a lot of great questions, a lot of answers. This will be posted on our YouTube channel in a little bit, and we'll send this out. So thank you, and then here's my information, contact information, as well as Rob's. And thank you guys so much. Rob, anything else in closing?
No, that's all for now. We've covered some pretty big issues that are out there in the industry, so thanks, Brian.
Yep, absolutely.
Thank you to the readers and the listeners.
Yep. Thank you. Have a good one, and enjoy your beautiful California weather.
Will do.
Thank you.